Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 5th of March. And not much change during the week. There was enormous strength continuing around the world in stocks. Not so in Australia, which is becalmed and not trending at all. But certainly, if you look at many places elsewhere around the world, there really is terrific strength. And of course, whenever we get these sort of markets, it just brings the thousands of commentators out of the woodwork that want to try and call a top. And they've been doing that now for quite a number of years, and they've been spectacularly unsuccessful. Those that have gone short the market have been absolutely slaughtered. Those that have been out of the market, of course, have missed out on a fantastic rally. And so I just want to reiterate again what I've been saying for years, and that is that you stay with what is until it isn't. And sure, you look for signs in the short term because you don't want to give too much of your profit back. So I'm quite happy to and willing to change my position within a 24-hour period. But until you actually see some evidence that things are changing, then you stay with what is. So let's examine where we're at the moment. And try and anticipate what actions may be required over the short term. But the S&P ended up higher by another 16 points on the week, so new all-time highs. If you think back, it wasn't that long ago that people were agonizing over whether the Dow Jones would reach 20,000. And just a few short weeks later, that's been blown away. And in fact, the Dow Jones has gone beyond 21,000. So this rally showing no signs of peaking. Now with the S&P, I'll show you an analysis of it in a minute, but my thinking at the moment is that it's quite possible we'll get a short-term pullback, probably just of a few percent at any stage, because that would be normal. And I expect the short-term averages to offer support, and I'm talking probably 20-day moving average here. There's just so much strength in this market that it's hard to see it coming back much more than that. So we'll look at that in just a minute. Any rational examination of what's been going on since the US election in November, concludes that this is not just a Trump rally. The rally, in fact, started before the election. And yes, there's been a few euphoric surges with the election result, and then of course with his address to Congress the other day. But this is not just about a Trump rally. Otherwise, it would have fallen over by yet, because there is no real substance yet to what he intends to do. We know the direction that he wants to head, but he hasn't defined the detailed specifics of it. And secondarily, I think most people would acknowledge, and the White House is acknowledging, that the impact of these policies in terms of tax and stimulus are probably not going to be seen in the economic numbers until 2018. So this rally is based on a heck of a lot more than just the fact that Trump is in office and he's going to cut taxes. Now, the true valuations are better than they look. Every week I comment on the fact that the bearish commentators out there are falling over themselves to tell you how overvalued the US market is, and they've been telling you that now for several years. And I just want to make another point that I think that the true valuations are actually better than what they actually look. And I think on the surface they look okay. But I think they're actually better than that. And that's primarily because there's an enormous amount of cash on the balance sheet of a lot of the major corporates, well in excess of $1 trillion. And if you strip that out, then you come up with an even more attractive PE ratio. There's also relatively low debt, which is also distorting the PE ratios in terms of valuations. And I guess the final point I want to make is that you can't ever look at PE ratios in isolation. It's strongly relative to two things. One is forward growth prospects. So high PE ratios and even higher future growth rates are absolutely fine. That's completely justified. And the second thing you need to line it up against is because the financial system works on money going where it's treated best. So you've always got to look at the earnings yield of stocks versus the yield that can be obtained from a 10-year US government bond. And at the moment, there is still a sufficiently big enough differential. The earnings yields are in excess of 6%. The 10-year yields around about 2.4. That is still a big enough differential between the two to encourage investors to stay in the stock market and not go back into bonds. So looking at PE ratios and concluding that they're high and therefore the market is overvalued and therefore it must crash is almost ignorant stupidity in my view. So just ignore those people because they're just trying to make a case for their own purposes. And the final thing I want to say on valuations is that the global economy is doing better than most people are prepared to acknowledge. If you look at the economic numbers, even coming out of Europe, and I'm no strong advocate for investing in Europe, but things are going better than what is being prepared to be acknowledged when you really get down and look at the hard data. And also, we've still got the impact of Trump stimulus still to come. That hasn't hit, and that probably won't hit until later this year and probably 2018. So for all those reasons, I don't believe the US market is overvalued. I'm not concerned by that. I'm just watching really the technical patterns that are unfolding. So let's take a look at those. This is the S&P on a monthly chart. This is the low in 2009. This was the peak in 2007 at around 1500. We're now starting to push on towards 2400. So those people that have stayed out of the market since the GFC have paid a very, very heavy price for doing so. We're in the fifth leg of this move higher. I expect that this will be the last significant leg higher until we get some sort of more significant correction like we saw here in 2000 and like we saw here in 2008. However, this could still take another year or two to run. It's been running now since 2009, and from a purely technical point of view, this doesn't have to end anytime soon. You can see here on the RSI that it got to overbought, which is where it's just reached now, in June of 2013, and it remained there for nearly 18 months, in fact more than 18 months. So there's no reason that this rally has to stop anytime soon. Let's look at the S&P on a daily chart, and you can see we're pretty elevated above the 50-day moving average, and that's why I think a short-term pullback of at least a few percent is inevitable and probably this month. We're overbought, more overbought, and for longer than we've been for some time. So the market certainly is fairly ripe to do a bit of reversion to the mean. Let's put a moving average on this, a shorter term 20-day moving average. So I'll just change that to 20, and let's just change the color so you can see it more clearly. So this green line here is the 20-day moving average. I would be surprised if the market pulls back to any greater extent than the 20-day moving average because there's just so much strength. You can see we haven't even come close to touching the 50 for some time now. The other thing that I want to do is just put a Fibonacci retracement on this structure as well, and that gives us a 38.2% retracement, which comes in at around 23.36, and that corresponds right now with that 20-day moving average. We've also got a little bit of a gap here which may get filled. That could bring us down to 23.70 if it was a very shallow correction. So if you want to look at a potential target zone for any correction, then I would say that is your target zone right there. So I think at the moment you certainly should be looking, or not looking for opportunities, but certainly looking for reasons to take a bit of money off the table. If you see any intraday reversals, as I talked about last week in stocks, then don't be shy about taking some partial profit because I think it's inevitable that we're going to get a little bit of a pullback, but I don't expect it to be very much. If you're a long-term investor, then and you're happy to go sit through the fluctuations and not try and be a bit more aggressive in your the way you manage your portfolio, then frankly, there's no need to really do anything at this point in time. Let's turn to Australia now. Sorry, let me just go back to, I just want to cover a few other things here. So that's the S&P. Let's just look at the NASDAQ, which is technology has been enormously strong. That's continuing with its really powerful run up, and you can see that it's been overbought now for quite some time, since January. It's been overbought nearly all year, but it still keeps marching on, and there are just no signs of reversal. However, we are quite extended above the 50-day, and therefore I think it is inevitable that we'll get a little bit of profit taking come in. Let's look at the Russell 2000 on small caps. Has underperformed, relatively speaking, in the last few weeks, but as you can see, it's at all-time highs, and there's really nothing, there's no sign there, it's just consolidating, no retracement. So I'm still quite comfortable with the small cap side of the market as well. There's no signs of distress there at all. Let's look at the US dollar. There's the US dollar index. It's you can see we moved up to 103.5. We pulled back to support around 100. We flicked around there for a couple of weeks, and now we're starting to advance again on the US dollar index. So not sure where it'll go in the short term, but the trend is probably higher until the Fed just makes a decision on interest rates in the next week or two, and then we'll see where it moves from there. Now, the other one that I want to mention also is the FTSE index, the UK stock index. Now, you remember Brexit. Brexit was back here in June. Brexit was when the US economy was going to, the UK economy was going to hit the wall. Stocks were going to get slaughtered. Banks were going to crumble. The sky was going to fall in the UK because of that Brexit decision. Well, here it was here, 2 days, and now look where it is. The FTSE is now finally breaking out. These are new all-time highs. Who would have thought? Just back in June, July, with all those dire predictions, people were so sure that the UK economy and the UK stock market was going to crater. And just look at that. So that's why I just reinforce yet again, do not follow what the media and consensus opinion tells you, because so often it is wrong. The vast majority of the time it is wrong. You do not take your cues from the media and from consensus opinion. Turning now to Aussie stocks. The Aussie dollar rose a little bit. We were down at 75.5 last week. We rose to 75.9, and most of that occurred on Friday night when the US dollar cooled off a little bit. So it's really just fluctuating with other currencies and with commodity prices. Our index was down 10 points for the week, still going nowhere, as opposed to all the other major indices around the world. It really is very disappointing. There's hardly anything in Australia that's trending. Yeah, we get some short-term moves up, but then they tend to get washed out again. And yeah, it's just a very hard market to make any forward progress at the moment. The US market far more productive, that's for sure. So let's take a look at the Aussie index. Well, first of all, we'll look at the Aussie currency. So we're still in this range between 71. This range has really been in place now since May last year, so getting on towards a year, between 71 and 78. And we're in the upper part of that range and really just at the mercy of whatever the US dollar does. Turning now to the ASX 200. Yes, we're above 5,600. We're up to 5,800. And I was talking to someone yesterday, and they were saying, "Oh, the Australian market's going well, isn't it?" And someone who doesn't watch the market too closely, and I said, "Well, not really. Uh, it's at 5,800. It is still. Let's go back to 2007. That's where we sit with respect to 2007. We're still miles below where we were in 2007, and yet look at the US market. It's more than 50% up on its 2007 highs. So you just got to keep these things in perspective. We've also got some resistance up here at 6,000. We've really been stuck in this range between, so roughly 5,000 and 6,000 now for some time. We're getting towards the top end of the range. Yes, there's been a trend since February of last year. There's no question about that. So there is a trend in place. However, that trend has certainly stalled since we had the breakout, and our market has not moved along with other global markets, not even close. Turning now to precious metals, gold dropped by $23. That was largely about rate hike expectations. And if you recall last week, I made mention of the fact that gold stocks had started falling where the metal hadn't. Well, I posed the question whether that was foreshadowing the underlying metals coming off, and the answer we got through the week, of course, is yes. Yet again, it did. Gold stocks pointing the way down. The world's largest ETF, GLD, which tracks gold, is the holdings in that are still anchored at 841. It's been there now for 2 weeks. So people aren't selling gold in ETFs, but then again, they're not buying it either. So we haven't really seen that surge come in. Stocks are underperforming short term and may still have a little bit more to the downside. And this was what I wrote last week, a note of caution that gold stocks are not yet leading, and that's the way that it played out. Now, my view of precious metals is that some exposure is warranted, but you need to just keep the balance in perspective. Recognize that this is a highly manipulated sector. It's a highly volatile sector, and if you don't like the fluctuations, then you should keep your gold exposure to a much smaller level. So it's really all about balance is the key issue here. So let's take a look at gold first of all on a weekly basis. There we go. You can see we've had a nice rally off the lows, but a little bit of a pullback in the last week. Let's look on a daily. You can see 2 sharp days down on Thursday and Friday, but quite a nice recovery on Friday. So that looks quite good from a support point of view to see after only one solid day down, more selling on Friday, but then climbing back off the lows to actually finish a touch in front. And we'll see the same thing with silver. In fact, silver did even better and actually registered a rise. Turning now to GDX. So let's look at what the stock indices are doing. So again, stocks are not really being sold off really sharply. There's been a bit of a pullback, and they've underperformed gold, but then that's really just part of a normal retracement after an advance. That's all I think that I'm seeing at this point in time. Now, there's just another interesting spread chart that I'll show you here. So this is the HUI index, which is similar to GDX, and it's relative to the gold price. And you can see that we had a major advance. In other words, stocks led the way from January of 2016. So gold stocks outperformed gold by a considerable margin. And if you remember back to then, for longer term viewers, I said that there is a long-term average somewhere between 0.45 and 0.5 between the HUI index and the price of gold. Down here at 0.1, it was ridiculous. That meant that gold stocks were more than more than 4 times cheaper relative to gold than they should be, their long-term averages. We managed to climb back to 0.21, which was still about half the long-term average, or less than half. We pulled back in the second half of 2016 as part of the correction, so gold stocks led the way down. We then started pulling up again in the early part of this year. This is a little deeper and a little more unexpected than I would have thought, but nevertheless still doesn't change the overall big picture, and that is that at 0.16, gold stocks are about 1/3 of the price level that the long-term historical averages would dictate relative to gold. So there's still potentially a long way to go yet. Moving on now to other commodities. Copper dipped. It was steady. In fact, take out the word dip. Copper was steady at 269 and is just moving around with short-term currency movements. The longer-term fundamentals for copper look very bullish to me, so I think that's a sector with quite a bit of upside. Crude oil slipped slightly by about $0.50, and we remain stuck in this trading range between 52 and 55. Stocks have underperformed oil, so there's a couple of ways you can look at that. You could say, well, the stocks are foreshadowing oil to fall, as happens with gold, but then they've been in that position now for quite some time, and normally that lag is only a couple of weeks at the most. So I think that has had a chance to play out. Or the other way you could look at it is to say that part of any correction that happens in oil is already priced into stocks, and therefore there may not be too much more downside in stocks. I'm not sure which way. I'm still a little apprehensive about the energy sector. I would much prefer to be buying a bigger dip in the sector. Whether that materializes or not, we'll have to wait and see. But certainly I think energy offers some good opportunities going forward. There's the spot copper chart. And there's just one other chart that I'll show you. If I can pull it up. I think it's this one. No, it's not that one. No, I'm not sure what I've put it under. No, I can't find it. I'll get it up for next week. Basically, I was just looking at two indicators of inflation and the trends in those. Copper has a very good correlation with inflation, and it is trending up. And also in the bond market, the ratio between inflation-protected bonds and normal bonds, when that ratio trends up, it's also a good indicator of inflation, and both those indicators are trending up quite solidly. So it looks a lot more likely that we're going to get more of an inflationary environment than a deflationary environment, and of course longer term that'll be positive for gold. So to wrap it all up, stay with the strongest sectors. In the US, they are clearly financials in particular, and technology have been strong. You, however, should be responding quickly to intraday reversals. Take the opportunity to trim your exposure, lock in some partial profits. These are all just smart things to do. Cash up a little bit. So if we do get a bit of a dip in the market, or when we get a bit of a dip in the market, then at least you've got some bullets to fire. Only buy dips in the uptrends when a market is as extended and overbought as ones like this are. You don't want to go chasing prices. Just stay in cash and only buy the dips. And of course, the other side of this equation is to exploit the emerging sectors. So stay with strong sectors, buying the dip, but also exploit the emerging sectors that have been coming out of very lengthy bear markets, and therefore there's no real excess priced in. But I will give just a word of warning. Many of these emerging sectors are commodity sectors, copper, uranium, agricultural products, precious metals. So just watch that you don't get too out of balance there with commodities because they are, they are more volatile. Don't overexpose to any single sector, no matter how good the prospects. Don't panic if things go against you. There's always a way to recover rather than just, panic sell off at the bottom. And biotechs are looking good to me as well. Biotechs have had a horrid 18 months. They appear to have stabilised in a range and look as though they're starting to break out to me. So that wraps it up for this week. Here's my contact details for any non-members that may want to contact me. And I'm sure we'll have another fascinating week ahead of us. That's all for this week. Cheers.